Chapter 4, Scaling with Syndications. Take your investment game to the next level by scaling and investing with others. Lesson 1, what is a real estate syndication? In this topic, we're going to cover passive investors versus active investing roles, the structure of GP LP splits, the legal basics of what you need for a syndication, and is it worth your time? Now it's time to do some bigger deals. You can't scale with your own money forever. At some level, you have to go in with other people. And so, this is what a syndication does. Syndications equals group investing. You plus other people under one deal is a syndication. We find the deal, we manage it, we raise the money from passive investors, just like yourself. And it's like a team sport where we're the coach and we're the quarterback operating the deal. But you need to vet what team you're on to know that we're going to win the game. There's roles in this GP LP split. The two roles are general partner and limited partner. The general partner is the operator. That's the hustler. That's the person finding the deal, running the numbers, managing the property, making sure that everyone stays out of jail, dealing with tenants, with the lenders, with construction, with the timelines, with the zoning, with the city, with regulations. Everything falls under the operator. The GP team can also be split up into the operator and the funders, people who go out and raise the capital. It can also split into the construction component of the general contractor who's a part of the deal. And he's working at cost with his equity split in the general partnership positions. So we start an LLC and we split it up with the GPs and the LPs with a very clear-cut operating agreement. The LPs are the limited partners. They write the checks. That's it. They're passive. They watch the deal happen and they vet things while they get consistent updates. They don't do any work. They don't have to worry about tenants. They don't take the liability. But their job is to vet the deal. Their job is to trust that the person on the GP team knows what they're doing and knows that their money is safe in the investment. So how do the equity splits work? Well, that's the third part. Equity splits are typically split with the LPs taking 70% of the returns and the GPs taking 30% of the returns for the heavy lifting. Sometimes there's a preferred return where you get a monthly or an annual or a bi-monthly distribution off of the profits that are received during the life of the investment. So if we're in a deal for 3 years, year 1 to year 3, you're making 8% on your money with an 8% preferred return. And at the very end, you're going to reap 70% of the profits that we make. Sometimes there's a hurdle involved in it, where once we achieve a certain percentage back to the investor, the 70-30 position flips. And the LPs end up getting 30%, and the GPs make 70%, being rewarded for their hard work and due diligence. In all cases, the investor gets paid back first. The LPs are the preferred position. Now, number 4 is the legal stuff that you can't ignore. This is important. Pay attention. Once we raise money from other people, the SEC is now involved. We're in SEC territory, which means we can't just go posting on the Facebook saying, who wants to invest in our deal? We need a private placement memorandum. That's like the legal foundation for how this is going to work and who the 70% and who the 30% is and where they go and how much they get back. All of that is outlined in the PPMs. You're also needing an operating agreement, which shows the exact roles, responsibilities, how we exit, if you can take your capital back, what kind of penalties there are, if any. All of that is outlined in the operating agreement and the PPMs. Lastly, we need to be registered either as a 506B or a 506C. One of those can invest in with accredited investors, and one of them cannot market, but can go to any investor. This stuff is serious, and we have lawyers to take care of everything. We want to ensure that the trust is there, because if we mess up, we go to jail. The bottom line is that syndications help you scale your money without being an expert in commercial real estate. You get to do the bigger deals with more money in better markets that you have access to without just using your own cash. Syndications allow you to own a piece of an investment without lifting a finger. And this is how the top 1% end up building their portfolios and their wealth. We built this machine to make it accessible to people. And if you're ready to own big assets with smaller checks, well, then maybe look at syndications. Schedule us a call and let's see if it's a good fit as we answer questions.